Over the last few years, the global economy has been under significant strain due to high inflation and high interest rates. It appears the cracks are finally starting to show, leaving some wondering when the economic downturn, commonly referred to as a recession, will come. Others argue it's already here, and a few believe it may never occur. A growing sentiment called financial nihilism is partly fueling the current economic unease. This term describes a feeling of hopelessness where people believe the traditional paths to financial security are no longer viable. There is a perceived disconnect between the value of things and their actual cost. If you care about your financial future, you might want to stay with me until the end of this video, as I will introduce some solutions to safely pass this financial crisis. Please like the video and subscribe to our channel to get more updates. Now, globalization since the late 1980s has played a complex role in the current economic situation. While it initially led to a lower price for manufactured goods, it also caused wages to stagnate and asset prices like housing to skyrocket. This created a situation where necessities became increasingly expensive while traditional methods of wealth creation seemed inaccessible. This economic disparity is a major driver of financial nihilism, especially among younger generations who have never known an economy outside of globalization. There is no magic crystal ball to predict a recession with certainty. However, several indicators can help us understand the likelihood of a downturn. A recession occurs when the economy slows significantly, leading to job losses and substantial market downturns. The last notable recession occurred in 2007, resulting in an unemployment rate of 10% and a market crash of 55%. Technically, a recession is defined by 2 consecutive quarters of negative GDP growth, which measures the economic output of a country, including consumer spending, investment, net exports, and government spending. In 2022, the US experienced a technical recession with GDP declining in the first 2 quarters. However, an official recession was never declared. This decision falls to the National Bureau of Economic Research, NBER, a non-profit organization where just 8 economists decide using undisclosed criteria when a recession has occurred. Historically, the NBER has a lag in declaring recession, as seen in 2008 when they announced the 2007 recession only in December 2008, well after significant economic damage had occurred. Predicting a recession involves using various indicators despite their imperfections. One popular recession indicator is the inversion of the yield curve, where short-term interest rates are higher than long-term rates, signaling investors' expectations of future economic weakening. The lag effect of this inversion typically takes up to 2 years to impact the economy, aligning with the period since the Federal Reserve began raising interest rates, suggesting an impending recession. However, extensive government spending could delay this effect. Another useful indicator is the Duncan Leading Index, which examines specific GDP measures related to personal consumption and private investment. A falling ratio of these measures suggests a recession is imminent. According to the EPI research, the Duncan Leading Index started declining in 2021, indicating a potential recession in the next year. The severity of the recession can also be inferred from this index. A sharp decline suggests a severe recession. To confirm a recession, the Claudia-Sam recession indicator, or SAM rule, is used, which identifies recessions based on rapid unemployment increases. Historically accurate, this rule currently shows weakening economic conditions with a rise above 0.5, confirming a recession. These indicators, though useful, are often based on the lagging data necessitating proactive observations of local business activities and corporate earnings report. For example, earnings misses and guidance cuts can signal economic weakening. Globally, indicators like the Conference Board Leading Economic Index also point to weakening conditions, particularly in Europe. This index, comprising measures like new orders and consumer expectations, suggests declining economic confidence. Central banks' actions, primarily interest rate changes, significantly impact the economy and markets. High inflation levels today, reminiscent of the 1970s and 80s, suggest that central banks might struggle to mitigate the next recession. Consequently, a severe recession could result in high unemployment and significant market crashes. Consumer debt, which hit a record $17 trillion in 2022, exacerbates the situation as high interest rates make debts harder to pay off. Rising unemployment would worsen this, potentially leading to widespread defaults and economic instability. Inflation, specifically the Core Consumer Price Index, has been on the rise with a 6.6% increase in 2022. This marked the highest year-over-year jump in 40 years, driven by rising food, housing, and medical costs. As a result, consumers are tightening their belts, reducing discretionary spending on things like travel and entertainment, which affects economic growth. Interest rates, the cost of borrowing money, have been climbing since the Federal Reserve raised them from near zero levels in March 2022. Higher interest rates increase the cost of loans for homes, cars, and businesses, leading to a slowdown in spending. This slowdown, in turn, affects the stock market, which is influenced by consumer spending and corporate earnings. Global economic conditions are also contributing to recession fears. China, the world's second largest economy, is experiencing a significant slowdown due to its strict COVID-19 lockdowns, supply chain disruptions, and a slumping real estate market. This slowdown affects global trade and economic stability. In the Eurozone, high inflation and rising energy costs due to the conflict in Ukraine are creating economic instability. European central banks' rate hikes are intended to combat inflation but could lead to a recession by reducing economic activity. Despite these indicators pointing towards a recession, there is no consensus among economists on when it will hit or how severe it will be. Predicting the exact timing and impact of recession is complex due to many variables at play. To summarize, while a recession seems likely based on various indicators, it's crucial to stay informed and prepared to mitigate its impact on your job and portfolio. Being proactive with financial planning and investments can help navigate the uncertainties of an impending economic downturn. While traditional advice might point towards government bonds, their effectiveness in a high inflation environment is debatable. Here are some options to consider for a recession-resistant portfolio. First one, high-quality stocks. Companies with a proven track record of profitability and stability can offer some protection during economic downturns. The second one is gold. Historically, gold has acted as a hedge against inflation. Owning physical gold offers more control over your asset compared to gold ETFs. Bitcoin is a volatile asset class, but some believe it can act as a store of value due to its limited supply. It's important to carefully research Bitcoin and understand the risks involved before investing. Diversification is key. Don't concentrate your wealth in a single asset class. Spread your investments across different asset classes such as stocks, precious metals like gold, and potentially even some Bitcoin with significant caution to minimize risk. Remember, there is no one-size-fits-all approach to recession investing. Conduct your own research, understand your risk tolerance, and consider seeking professional financial advice to create a personalized strategy for navigating economic downturns. Like the video, subscribe for updates, and share this video to spread knowledge. Stay safe and thanks for watching.